Hey there, Blockhead traders. Here, Blockhead traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Friday, March 1st, 2024, and this is Blockhead Traders Weekly. In this week's episode, it's just myself, Sprocket888, and we are going to do a quick episode on an earnings trade that I put on this week. I had all the details in the Discord before I took the play, and this day we're going to show how it played out. Before we get to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. We'd love to hear what you're interested in trading, and we'd love to hear what content you want to hear about. You'll also find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available wherever you get your podcasts, and if you look for us and can't find us, let us know and we will get it there. But let's hop to this week's content. In this week's content, I want to cover one earnings trade that I took this week because we are pretty much in the heart of earnings season. Going to start pulling out of earnings season next week. It's going to start winding down. And I had done a little screening leading up to this week to see what type of trades might be out there. And as a recap, I really look for the super extended volatility trades, basically those underlyings where volatility is just uber stoked and way beyond where it normally sits. And it's those trades that I try to get into, and I sell that volatility with the goal that the actual earnings move will be less than the volatility is actually implying. And the amount of volatility contraction that comes right after earnings is incredibly powerful deflation of the values of the options. And so it's a binary event where 9 times out of 10, the volatility in those options are dramatically less as soon as the earnings announcement is done. So I like to come in just before earnings, sell that volatility and hope and anticipation of a volatility contraction where the price doesn't move too far out of the extended range. And then when you combine that with the volatility contraction, I can close those positions out for pennies on the dollar once the trading kind of opens and that volatility really deflates. And so in my screening of this play, I had come up on Advanced Auto Parts, ticker symbol AAP. And I actually put this in the Discord last week saying, wow, this one is prime for an earnings strangle. And to remind you what an earnings strangle is, this is where I don't want to take a bet whether the thing is going to go up or down. I don't really care. What my bet is that it's not going to go up or down more than the expected move that is priced into the options. So what I do is I sell a put and I sell a call. And if you remember, a put is to the downside insurance and a call is to the upside insurance. And I'm not buying this insurance, I'm selling it. And so the person that is buying it is wanting to protect themselves or profit if the move is outside of that expected move. And I am basically the insurance broker coming in and saying, okay, look, I will got you covered. If this thing swings out beyond where you're looking at, I'll go ahead and take the hit and I'll pay your claim out and I'll buy the shares at the top price if it goes way higher than that. And then that person makes bank if it extends far beyond that range, because I will buy them at that lower price, even though the price is way above it. And if it goes to the downside, I'm basically assuring whoever bought that option that I will sell them, or I will allow them to put those shares to me at that particular price. And so that is where I'm playing kind of both sides of that. And so let's take a look on the chain, the option chain. And so what I want to show you is that volatility contraction that I'm talking about. And to illustrate this, I'm going to bring up the chart. And when I bring up the chart here, you're going to see kind of two lines. The top one is a candlestick chart of the daily moves of the underlying of AAP. And the bottom, where you get this kind of green and red, this is my historical volatility chart. And this is kind of a custom chart that I put together that plots the current spot volatility relative to its historical value. And so this is an oscillating value between 0% and 100%. So when you get to 100%, it means This is as high as volatility has ever been. And as long as the spot volatility stays high or goes higher, it will stay at 100. Zero basically means it's never ever been lower. And when it hits zero, if it gets lower and lower, it stays at 0%. And what I want to call out here is these red and green bubbles, red and blue bubbles, sorry, on the top. These are earnings announcements. So there's one here, and then this is the most recent one. And what you see here is every single one of these earnings, you get kind of a ramp up. So when this lower indicator is green, it basically means you're above 50%. You're starting to extend that volatility above where it has been historically over the past year. And the higher that green gets to closer to 100, the more juicy the play. And what you can see right here is this most recent earnings, going into the earnings, is we were pretty much right at 100%. It was like 99.4% historical volatility, which means in the past year, it has never been more volatile than it was going into this earnings. And what you're looking for is this consistent cliff that comes after every earnings announcement, and that's that volatility contraction. And so this ramp up into earnings was exactly what I was looking for, is when you get up in the 80%, 90%, now you're talking extra extended volatility. That's where I went in to sell that premium, because I was banking on that expected move to not be as volatile as it was indicating, but I'm also betting on that contraction of volatility. So to give you just an idea of where this spot volatility was going into earnings, so I sold these options the day before earnings. Earnings were February 28th before the bell. So I sold these things on February 27th. The spot volatility on the option chain that I was selling was 275%. So within 10 minutes of the opening bell the following day, remember they reported earnings before the opening bell, so all that volatility was gone. Now you can't see it priced in until the market opens, but when the market opened, that spot volatility had fallen to 80%. It got as low as about 75%. And so we went from 275% to about 75% on market open. So you might ask, well, what does that look like from a selling perspective and a profit perspective, and how does that work? And so let me jump over here to the little by the numbers that I put together here. And so this is the earnings play of AAP Strangle. I went with approximately a 20 delta Strangle. Now, I was about 20 delta on the put side, and I believe I was a little bit conservative on the high side, and I didn't stick with the 20 delta. I moved out to the 16 delta because this thing had some terribly high call skew, which means the option premium on the call side was dramatically more than the put side. What that usually indicates is the market sees more risk to the upside, meaning it's more likely the people placing all the option bets were speculating that this stock was going to go up after earnings, and hence the higher premium on the call side. Now, because selling a naked call on that side basically has infinite risk, because there's no limit to how high they can go. And because I lose money the higher above the strike price it goes, it basically would open yourselves up to a kind of an infinite loss. And so I get a little bit nervous on the high side. And so I brought that delta down, which lowers my risk a little bit. So that's why it was about a 16 delta on the call side. And where that put me was very, very wide. So I believe the underlying was trading around the $60, $63 mark when I put the trade on. And my strikes were, hey, I believe this stock is going to stay above $54. That was my put side, a $54 strike put. And I said it's going to stay below $80. So that was the high side. That was my $80 call. So I said, as long as the stock stays between $80 and $54, I will be just fine. And the premium for those two options was actually $2.75 per contract. Now, contract equals 100 shares, so that basically netted me $275 for every contract I sold. I sold 4 contracts to basically fit the buying power and risk tolerance of my portfolio. So I collected about $1,100 in premium from selling that option on February 27th. Now, this is a very quick turnaround. It's a binary event. Earnings came out before the bell on the 28th. And as soon as it came out, price fluctuated around a lot. It jumped up, jumped down, but it settled not that far from the close the previous day. A little bit higher, but still not terribly. I'll show you my Flappy Bird chart in a minute. That is when the volatility went from 275% to basically 75%. And now my 20 delta and 16 delta strikes all became like 2 delta strikes with hardly any premium, almost to expiration. So there was almost no value left in them. And so that morning, within 30 minutes of the opening bell, my position was able to be closed out for 20 cents. So I bought back my position at 20 cents a contract. Remember, I sold them for $2.75 a contract. So I bought each contract back for $20. There was 4 of them. I paid $80 to close it out. So I had collected $1,100. I paid $80 to get them back. That means my net profit on the trade was $1,020. Now, there's risk involved, and basically that consumes buying power, basically capital that I'm not allowed to use while my trade is open. And so I do a calculation called return on capital. And so this particular position required about $4,400 of buying power that I had to surrender to the broker while this trade was open. And so my return on capital is my profit and loss divided by my buying power reduction. So in this case, it was about a 23% return on my capital in basically less than 24 hours, overnight, if you would. So one of the things I like to do to illustrate where this is graphically on the chart is I like to show the Flappy Bird chart. And the Flappy Bird chart is basically, I plot this red bar on the top, this red bar on the bottom. And that red bar is basically outside of my strikes. Now, I'm not taking into consideration the premium here because technically there's a yellow area before I actually lose money. So I don't lose money as soon as I cross that strike. There's a little bit of premium that I get that cushions that. But to make this a little bit simpler, I just show them as red. And so for me to get my maximum profit, I basically need this stock to stay between these 2 bars. And this is a 4-hour chart. I'll zoom out here real quick to the 1-day chart just to show you where this thing sits like historically, so you can just see how far. These are all daily moves or daily candles that I got here on the screen. And I mean, that volatility, the higher the volatility, the farther apart these Flappy Bird pipes are. And so the less volatility there is, the tighter these are to the stock price. And that's why I like to go when volatility is very, very high, because that increases my probability of success because it really stretches out, where this fits in. And so if I go ahead and then zoom in, I'm going to zoom into 2-hour candles because it'll show it a little bit more because it's a very, very quick trade. It was done basically overnight. In this 2 hours that I'm talking about. Now the bars go all the way out to expiration, but I closed this position basically the following day. So I closed it right here before this candle drop, just to as soon as it opened up. So I was already at 92% of my potential profit. So there's no sense in risking all of that profit that I could have put in my pocket just for the extra $80, which is why I closed it out when I closed it out. But you can see if I'd have let this go to expiration, I'd have been fine. So this kind of ramp up here at the very beginning, this is the beginning of the 27th. I put the trade on probably midday, somewhere around there, where it was probably around $64 a share. Closed. This right here is the early morning. This big green candle, it got as high as about $72. That's as high as it got. It thrashed down pre-market down to $63, but nowhere near that $54 down here and $80 up here. Market opened, your hey diddle diddle right down the middle. All the volatility was gone. I was able to close those things out at 20 cents a share right there. And this was like textbook volatility contraction. So that brings us to the end of this week's episode. Like I said, really quick episode. Just wanted to recap how that advanced auto parts play panned out. It was called out in the Discord the week prior to earnings. I do plan to screen this weekend. Of course, this will come out after the weekend, but looking for earnings trades that will be out next week. There still is a good bit of earnings. There still is a good bit of extended volatility. I always like to drop those suggestions or possible plays in the Discord. So hop in there, say hello to us, check out potential plays coming up. And if that is your type of thing of playing these binary events, it's a ton of fun. I love to do it. You get to do it 4 times a year when earnings season comes around. Earnings season typically lasts 3 to 4 weeks, where you get real heavy earnings announcement for those 3 to 4 weeks. And so in general, that covers a good bit of weeks out of the year. So, comes around 4 times, get about 3 weeks out of it, 12 weeks out of the year, something to trade. Then I'll fall back the rest of the time on my regular premium selling, where I extend out my time a little bit more to that 35 to 45 days to expiration. But hopefully you're finding things to trade out there in this market. There's a lot going on. We're at all-time highs at almost every index. A lot of people are saying we're going higher. The way that I trade, whether it goes up or down, I'm selling the premium. So I'm not really so concerned whether or not we're going higher or lower. So good luck out there. Have fun. And remember, think outside the block.